Hello again. Welcome to today's video, and today I want to introduce you to the lazy method to purchase property and become wealthy. I recently saw this cult called the FIRE movement. FIRE stands for getting fired from your job and become rich by making money online. Actually, I'm just kidding. FIRE stands for financial independence and retire early. Check it out on Google, guys. A lot of millionaires, especially the young millionaires, the 30-year-old millionaire, become wealthy by working really hard. They do a bunch of things. So they work long hours, they do side hustles on top of their day job, they invest in the share market, they read up a bunch of investing techniques, they do a lot of things, and they work really hard, and they save a lot of money. In fact, sometimes working very hard is not enough. A lot of these young millionaires also get really lucky, and that's one of the key contributors to their success. But you know what? Recently I have been doing a lot of thinking. I realized that for you to be happy and to be a millionaire, you do not have to have $1 million in your 30s. If you are not in a rush, if you can wait, let's say 50 years to have $1 million, it's actually very easy to get there. The secret to having $1 million without doing too much work is to have the power of compound interest working for you over time. Let me show you this chart on the Australian government website moneysmart.gov.au. As you can see, if you save $100 per week and you do this consistently for the next 50 years, if we assume your investment earns you 5% per annum rate of return, you will have over $1.1 million at the end of the 50-year investing journey. In total, you only contribute $260,000, but your interest and investment income add up to around $900,000. So altogether, you have $1.1 million, and the bulk of the money comes from the power of compound interest without you having to do any work. Another way of saying this is that you get more free money from somewhere compared to the amount that you personally contribute out of your own pocket. This is why the rich keeps getting richer, because they get a lot of free money over time. And this is why the poor tends to remain poor. So to be a millionaire in 50 years, the only thing you need to do is to earn a rate of return of 5% per annum and consistently save and invest $100 each week. Now, one way to invest $100 each week is to invest in the share market using investing platforms like Raise, Spaceship, or Comstock Pocket from the Commonwealth Bank. These micro-investing platforms will happily accept $100 from you each week, and they charge you very little fees. This getting rich strategy is called the borrowing method on the screen that I have prepared for you guys. So one way to get to $1 million is to undertake the borrowing method of becoming a millionaire. And this will make you a boring person. Now, what if you do not want to invest in the share market? You can buy a property. It's difficult to invest $100 a week into property because a property usually costs a few $100,000, not $100. So what you may want to do is to save around 8% of the property purchase price, because this is the sweet spot for a lot of banks in Australia for you to minimize your lender's mortgage insurance premium and increase the chance of approval. And in Sydney, if you are a first-home buyer, you do not have to pay stamp duty if your property purchase price is no more than $650,000 and the property is a second-hand property. So you can save 8% of $650,000, and that is $52,000. Let's add a bit more for your solicitor and for some other costs which you may not know upfront. Let's call it $55,000 altogether. Now what happens if you invest $55,000 as a big lump sum And let's say that you get there by saving $100 a week. So that will mean that you take 10 years to accumulate $55,000. And now you only have 40 years to actually grow your investment. So you take 10 years to save $55,000 and buy your first home. And after that, for the next 40 years, you invest $100 a week into the share market using Raise, Spaceship, or Comstock Pocket. It turns out that you essentially get the same figure, roughly around $1 million at the end of the 40-year investing period after you purchase your first home. Now, to achieve this goal, you will need to make sure that the $55,000 that you invest into your first home earns you a rate of return of at least 5%. This is not the growth rate of your home value, it's the growth rate of your equity compared to the amount of cash that you put in. And because you are borrowing money from the bank, usually this means the growth rate of your property can be smaller than 5%. So what needs to happen to make sure that your investment earns you a rate of return of 5% per annum? If you want to be super accurate, you have to get down to the nitty-gritty. It will be a complex calculation, so we're not going to go into it too much. To save you the trouble, I will just give you the final figure. In short, if your property grows at a rate of 2.3% per annum, and your home loan interest rate is 2%, your cash-on-cash return is going to be around 5% per annum. I am showing you my calculation on the screen anyway if you want to have a look if you are a bit of a nerd, but please do not get too bogged down into it, it's a bit complicated. I've assumed that you only hold the property for 5 years, so your LMI insurance, your purchase costs, your selling agent commission, and your other selling costs are spread out over 5 years. If you hold the property for longer, these one-off costs will be expensed over a larger number of years, so the yearly expense will become smaller and the hurdle capital growth rate can be smaller as well. Now, if you buy a home that you live in, you do not need to pay rent. So even though the property does not earn you rental income, you are effectively earning money from it because you do not pay rent for you to live in the home. So with this in mind, I have added your rental savings into the calculation. If you live with your parents, you do not pay rent, and you're happy to continue doing this for the rest of your life, then you should remove this rental savings. And if you do that, the capital growth rate needs to be around 4% per annum, assuming you only hold the property for the next 5 years. So the next question is it realistic for your home value to grow at 2.3% per annum or more? We cannot predict the future, but I would say yes. On the balance of probabilities, it will. It is reported that over the last 40 years, the average capital growth rate in Sydney is 7.4% per annum. So there is a lot of margin for error. It's very huge buffer right there when you compare 2.3% per annum versus 7.4% per annum. In fact, if you are able to achieve a capital growth rate of 7.4% per annum, your cash-on-cash return that you can see on this model here is going to be 77% per annum. Again, do not get too bogged down into it. My model is actually not perfect, and that's why I say simplified on the screen here. But what I am trying to say is that your cash-on-cash return is likely going to be extremely high if your home value grows by 7.4% per annum. And this is the main reason why I like buying a property compared to buying shares. My cash-on-cash return can be extremely high if my property performs at the average capital growth level for my city, and even if my property underperforms, my cash-on-cash return is likely still going to be reasonable. Now I want to show you a few different ways for you to achieve financial freedom. On the screen in front of you, you will see 6 different ways for you to have $1 million. I will try to make this a little bit entertaining for you guys. By the way, I'm not a financial advisor, and I'm not trying to give you any financial advice or any advice whatsoever. So let's be clear on that. This is me simply expressing my belief as someone who has learned finance at university and someone who has read up on the FIRE movement on the internet. I am confident that I know what I'm talking about, although you should really do your own research. So like I mentioned to you before, a lot of young millionaires get to where they are by working really hard and saving a lot. Some of them have $1 million before they reach 30, but then after they have $1 million, what do? I realized recently that I want to keep making progress if I want to be happy in life. So if I already have $1 million by the time I am 30 years old, for me to keep making progress, I need to make more and more money and work harder and harder. This kind of lifestyle is not sustainable and it is probably not the best lifestyle for the majority of people. Why would you want to work harder and harder and push yourself harder and harder to keep making progress so that you can feel happy? Why not just make the progress a lot slower to begin with so that you have $1 million not by the time you are 30 but by the time you are 70 years old? So if you build up your nest egg slowly from when you are 18 until when you are 70, you make a small gradual progress consistently every single year for the next 50 years until you get old. I would rather get $1 million by the time I am 70 so that each year I keep making slow and steady progress towards my goal of becoming a millionaire so that I do not need to invent another goal in life. So here we go, let me introduce to you the lazy method of becoming a millionaire. Okay, that was a bit of a joke by the way. I don't know for sure whether I will choose the lazy method because I actually like working hard, but honestly this method works for the majority of people. That's why it's called the lazy method, because it works even for lazy people. Okay, so how do you reach $1 million net wealth if you are lazy? So you buy one property, I repeat one property only, and that has to be one modest property. So a property that's under $650,000 if you are in Sydney. And you have to do this at a very young age. You save $100 a week starting from when you are 18, so that by the time you are 28 years old, you already have $55,000, which is 8% deposit towards your home purchase. Depending on who you are, your lifestyle, your family situation, you may find it very easy to save $100 a week, but you may also find it difficult. So if you believe that you are not sure how to save $100 a week, you think you need a bit of a hand, then please contact me. I have a couple of videos that I think are very useful for you. I am a natural cheapskate, so I know a lot of tricks that will help you reduce your living expenses, lower down your grocery expenses and entertainment expenses and shopping expenses, so that it's a lot easier for you to save $100 a week without having to make extra money. So you don't need to change your job and you do not need to do side hustles. What I think is extremely important for young first-home buyers is to have a very flexible mindset. A lot of Sydney-siders want to buy a house. It's very difficult for you to buy a house if your budget is under $650,000. It's possible, but it's going to be very difficult. You have to buy a house that's very far away from the Sydney CBD. You really need the price to be under $650,000 because you do not want to pay stamp duty. So you need to aim for apartments instead of freestanding houses. To make it easy for you, for the lazy method of getting rich, we will focus on buying a second-hand property because that is probably the easiest way for you to buy a property without getting ripped off. It's like if you buy a car, you buy a second-hand car because it tends to be cheaper and it's less likely for you to overpay. Isn't that right? Don't get me wrong, brand new properties can be excellent asset to buy, and you do get some additional government benefits if you buy a brand new property. But it is more likely for the property to be overpriced. So in the first couple of years, you may see negative capital growth. And that is not a good feeling. And what I find is that if it is brand new, because the property tends to be more expensive, you may not have enough borrowing power to borrow that much. So because this is called the lazy method, we will just focus on one type of property, and that will be a second-hand property, which is likely to be an apartment in Sydney. Now, okay, apartments are bad. They go down in value. Yes, that is quite possible, but it is not certain. Sometimes apartments go up as well. It's equally likely, and in fact I think it's more likely for an apartment to go up in value over the next 40 years compared to going down in value over the next 40 years. So if you buy an apartment within 10 years of becoming an adult, and then you hold that apartment for the next 40 years, it is very likely for that apartment to have gone up in value at the end of your holding period. Now, I want to be crystal clear, the lazy method is not necessarily the best method for you to get rich. It's probably not the best method for the high achiever, because there's the hard-working method that's probably the best for the high achiever. But the lazy method is a method that works for lazy people. It is of course possible for you to achieve a higher return by purchasing a freestanding house or by purchasing an investment property in a regional location through one of those property gurus, one of those property moguls. But you know, buying a house is quite difficult, right? You set your goal too high, it's in the sky. And because it is so far away from you, you may end up giving up before you buy the house. Now, buying a property in a regional location is probably not that difficult, but then you may have a bit of trust issues because you need to buy this through one of those buyer agents, one of those property gurus. Can you trust the property guru who is recommending you to buy in that location? Do you want to pay $10,000 or $15,000 to the buyer's agent? And do you even have that extra money? Because according to the lazy method, you are buying your property with 8% deposit because you only save $100 a week over the last 10 years. So chances are buying through a buyer agent is not suitable for you. Have you heard of a guy called Dave Ramsey in America? Do you know what he does? He helps thousands of Americans become wealthy by saving money, reducing expenses, and paying off their debts. He asks people to pay the smallest debt first, not the most expensive, but the smallest one. So if his client has a small debt that is interest-free, like if you go to Harvey Norman, you normally get interest-free purchase using a credit card. Dave Ramsey wants you to pay off that debt first because it's only $2,000. It's the smallest one amongst your other debts. So even though it is interest-free, Dave Ramsey recommends you to pay off that debt. By paying off the smallest debt, you get a sense of achievement. You feel good, you feel happy, you feel motivated, and you want to keep going and pay off your bigger debts. So you start by paying the smallest debt first, and you slowly work your way up and chip away at the bigger debts. This method is contradictory to what is mathematically the best way of paying off your debts, right? Because mathematically, you want to pay off the debt with the highest interest rate because that debt actually causes you to incur more charges every single day. So you want to start with that debt first. So Dave Ramsey's method is actually mathematically very dumb. It's the dumbest way ever to pay off your debts, but it works. It works for thousands of Americans. Thousands of Americans successfully get rid of their debts and become millionaires by following this mathematically dumb method of paying off debts. So the lazy method is a bit dumb as well. It's not the dumbest method ever. It's not as dumb as the Dave Ramsey method, but it works like this. You rely on the power of compound interest and leverage to work for you and help you get rich and have $1 million of net wealth. You want to work with compound interest and leverage over a very long period of time. because the longer you have to invest and to take advantage of the extra money from the bank, the more interest and investment return that you will receive for free. So you save $100 a week and you buy your first home with 8% deposit. The price of your first home must be no more than $650,000, and that home should be a second-hand home, which means it is probably a second-hand apartment. If you really want a house, you have to choose a suburb that's very far from the Sydney CBD. For example, something like Mount Druitt. Your deposit, solicitor fee, and other purchase costs will be around $55,000. And because you are saving $100 a week, you will be able to get there after 10 years of saving up for your first home. It's slow and steady, but it works, okay? Now, if you want to make sure that you get there within 10 years, you may want to actually save more than $100 a week. The reason is in 10 years, it is quite possible for the property price to have gone up. It may even have doubled. If possible at all, you want to save $200 a week during your first 10 years of becoming an adult. Okay, so save $200 a week if possible as soon as you turn 18 until you have $55,000 or whatever is around 8% of the property purchase price that you want to buy. If you have a boyfriend or girlfriend, what you can do is actually you can save $100 a week, and then your boyfriend or girlfriend can save another $100 a week. So the two of you together, working together, will be able to save easily $200 a week. Genius, right? Now I mentioned before that you want to buy a property that's second-hand apartment, or if you want a house has to be really far away, but you have to buy a property that you are reasonably happy to live in for the next 5 years. Ideally for the next 40 years, because you need another 40 years to have $1 million, but at least the next 5 years. So what this means is that you want this property to have at least 2 bedrooms. So one room for you and your partner, another room for your children or your future children. If for whatever reason a few years later you suddenly have a lot of children, then you can explore the possibility of buying a bigger home at that time. Okay, so you do not need to buy the big home today. You can buy that 5 years later if you do need a bigger home at that time. This is a very important mentality, because if you want to buy a big home today, chances are your borrowing power is not enough and your deposit is not enough. You need to save way more than $100 a week if you want to buy a large home today. Now, even if in 5 years time you cannot buy a bigger home because your borrowing power is not enough, what you can do is you can actually move out and rent a larger home, and then the home that you currently own can be converted into an investment property. So the mathematics behind it is still going to be reasonably similar. You can still build wealth by converting this home into an investment property. You get rental income. You may need to pay tax when you sell the investment property. So it just means that your after-tax rate of return may be a bit smaller, but you will still get to $1 million net wealth if you wait long enough. I think 40 years is still more than ample time for a Sydney property. So you do not need to worry too much about not being able to have the perfect home today. As long as you're happy with that home for the next 5 years, I would say it is good enough. You want to buy your first home as a home that you live in. You do not want to rent it out from day one because you want to get the government concession. You want to get the stamp duty waiver, and you want to be able to buy with 8% deposit. If it is an investment property, a lot of banks at the moment require you to have around 12% deposit. So it's going to take you a lot longer to get there if you only save $100 a week. Now you have your home, right? You have your home, you have purchased your home. What's next in your investment journey to make sure that you have $1 million by the time you retire when you are 70 years old? The next stage of the lazy method of becoming wealthy is to continue to save $100 a week after you purchase your first home. But this time, instead of saving the $100 a week into a savings account, you put it into the share market. That's using micro investing apps that I mentioned to you before, which are Comsec Pocket from the Commonwealth Bank, or Raise, or Spaceship. By the way, I have referral codes for Raise and for Spaceship, so if you sign up through my referral code, you get a little bit of a bonus. I think from memory it's $5 or $10 bonus. Free lunch. Now you continue to invest in the share market through these micro investing apps for the next 40 years until you retire with $1 million of net asset. About half of it will be in the share market and the other half will be in the equity in your home. By the way, this video was made when New South Wales has the stamp duty regime. Soon we will move to a land tax system, so the exact figures in my model will be a little bit different, but the principles will remain the same. The lazy method will still work. This is a timeless method, guys. It will work almost every time, almost any time. It is simple mathematics, and this is a method that is going to be accessible for the majority of Australians, including those on a modest salary level. Before I end this video today, I want to remind you again that this is not financial advice, and I do not intend for this to be any form of advice. I'm only showing you the mathematics and illustrating what is possible if you take advantage of the power of compound interest and leverage. You can do any of the 1, 2, 3, 4, 5, 6 methods on the screen, and you are likely to have $1 million at the end of that journey. I personally think that the lazy method is a great choice, but you do not need to choose this method. Please do your own research and talk to your financial advisor before making any financial decisions. I am a mortgage broker if you haven't figured that out already by now. I cannot tell you which method to pick, but I know that a lot of Australians find it very difficult to save money and to create and grow their wealth. The biggest hurdle I'm seeing from my first home buyer customers is to save the 8% initial deposit, to save that $55,000. I am genuinely happy to help you guys save money. Even if it takes you 10 years to save up $55,000, I will happily be there for you guys. I will stay by your side until you get there. The only thing I ask of you as your mortgage broker is to come back to me at the end of your 10-year journey. Return the favor and I will be happy. And please stay in that loan for at least 2 years, because if you refinance or sell the property within 2 years, I will need to refund the commission to the bank. So if you can promise those two things, so one is to actually come back to me in 10 years time after you have $55,000, and two is to stay in that loan for at least 2 years, then you can tell me your whole life story. What things you have been spending on, what you are struggling with, and I can actually help you save money. I am a natural cheapskate, so I know a lot of tricks to help you save money quickly. I can analyze your spending habits if you want me to. I can analyze your bank statements and your credit card statements. I will give you a lot of useful practical tips to save $100 a week, $200 a week, or even more. I'm not promising you to get the cheapest loans, because I know there are a few online lenders who can give you a slightly cheaper loan compared to what the banks can give you, and these online lenders do not work with mortgage brokers. But to be honest, the difference in the interest rate is very small, and those loans tend to be more difficult to get approved for. I'm not promising you to get rich in the shortest amount of time by following the lazy method of becoming rich, but I strongly believe that the lazy method actually works for the majority of people. And you know, at the end of the day, as long as it works, I think it is good enough, isn't it? You can achieve financial independence after 50 years by following a very relaxed, easy, and simple method. You can retire in peace and that sort of thing. This is achievable without having to get lucky and without having to work too hard. So if after you do your own research, you have decided to go with the lazy method of becoming wealthy and you want some help to save $100 or $200 a week or more, please reach out to me and I will be right by your side for the next 10 years until you save enough money, and I will help you get your home loan as your mortgage broker. Thank you so much for watching all the way to the end. You are really awesome. If you see this video on Facebook, please give it a reaction, not just a like, but maybe a heart and a comment. Apparently it helps with the algorithm. Contact me to discuss your home buying plans. If you see this video on YouTube, please do give it a like, subscribe to my channel, drop me a comment. If you see this video on Instagram, please do like this post, follow me, DM me, whatever. I want to hear from you and help you become a millionaire. Before I go, I want to show you the Money Smart website again. It's a really powerful chart, you see. I want the message to really sink in. So you start with $55,000, which you accumulate in the first 10 years to buy your first home. And then after you buy your first home, you continue to save and invest $100 a week for the next 40 years. At the end of that journey, you will have magically in front of you 1 million Australian dollars, even though your out-of-pocket contribution is only $263,000.